All right, everybody have a good lunch?
Yeah.
All right, so here's the rule, no sleeping. Try to keep it active and engaged as we go through our next panel here this afternoon. So hopefully everybody's learned something, been inspired to do something, and you'll hear repeatedly the call to action, So this is where the rubber meets the road to some extent. We've had some high-level conversations, and I know several of you have approached me and said, well, how do we make this happen? So we brought an exciting panel together of professionals that can be part of your team to actually make it happen, the nuts and bolts. So today we have with us Rosemary Drake with the SBA, and I'm going to allow each panelist to introduce themselves. We have Mark Collier with the Small Business Development Center, and Mr. Terrence Albritton with Truist. So let's begin with a brief introduction, and then we're going to go through some of the nuts and bolts of how do we actually buy the business, starting with financing. But let's get the introductions first.
All right. I'm Terrence Albritton with Truist Bank. I'm in the Small Business Direct Department, where we have now a virtual small business banking center that allows us to be able to lend and offer banking products to anybody in any state, in any place within our footprint. And so that's all I do every day is talk to business owners and try to help get them in a place where whatever they need from capital, insurance, anything else, that we're able to meet them at their point of need.
And good afternoon, I'm Rosemary Drake. I am the Deputy District Director for the state of Georgia. For SBA, we cover all 159 counties in the state of Georgia. SBA has 68 district offices. I've been with SBA for about 10 years. Prior to that, this is my third career. Prior to that, I was a banker. I came up in the banking world. GE was one of our competitors. I worked for CIT and Heller Financial, so I did a lot of the deals, and Bank of America. So I did a lot of the transactions around business acquisition and other types of financing. Also worked in this building in syndications for Wachovia as an underwriter and portfolio manager for syndications. And so what I do at SBA, I'm mostly the operations manager here for the district, but I do a lot of speaking engagements because of my background and access to capital. Also in being with the SBA was the 7A policy chief, which is our 7A loan program, and I was the policy chief during the COVID years, implementing the policy for the PPP loans that many of you may have gotten for your small businesses. So a part of what I do is I like to educate small businesses on resources available to them, but also to help them from inception to succession of the business. Most often, people come to SBA after they've already had an issue, or they've discovered that they were declined from a lender and they come to SBA. So our goal is to reach entrepreneurs at the time that you have the idea, to help that vision so that you can start and structure the business to move forward. You're gonna have ebbs and flows, but our goal at SBA with your tax dollars is we do public and private partnerships to make sure that we can guide you through the process. You're still doing the work, we're helping guide you through the process, and I think that's a good segue to Mark.
Thank you. Good afternoon, everyone. My name is Mark Collier. I'm the Area Director of the University of Georgia Small Business Development Center in DeKalb. And we, much like the SBA, is the federal arm of the government. We're the kind of the state arm of the government. And we deliver services to small businesses in 3 areas. Confidential one-on-one consulting, continuing education classes, and I'm a huge believer in that. I think the savviest entrepreneurs understand the value of continuing education. Your competitors are out here getting better every day, so I always encourage my clients, you want to get better every day. You look at some of these continuing education classes, they're going to make you a better, more accomplished entrepreneur and give you a better chance for success. And the third area that we offer are market research services. We have access to reports such as Reference USA, IBIS World, which are industry reports, Industrious CFO, which are metric benchmarking reports. All those reports can be delivered to you at no direct cost. As Rosemary said, you guys already pay taxes, so I always encourage people maximize the value of the tax dollars that you're spending. Use our services. The panel before me, the recurring theme was you got to have a team, and with our resources here at SBA and SBDC, you do have a team. Alonzo's up here, and Mr. Hill, I know he's got a MBA in his family. Alonzo has an MBA. You don't have to go out and get an MBA. All the consultants in our organization, we all have MBAs. We can be your team. We can be your team that will help deliver the value that you need to get that competitive edge. I'm often out at networking events and they go, well, who are you? I say, I'm your competition secret weapon. And so a lot of people, that resonates with them. And we do great work. And we are a resource for you. I have no other vested interest than to see you grow and scale. Because our business model is a simple one. We help you grow your revenue, help you grow your employees. Guess what you do? You pay more taxes, right? So we're part of the economic development arm of the state. So that's what we do. Another recurring question I get is, what businesses do you help? Do you help startups or established businesses? We help everyone from what I call the newlywed to the nearly dead. But our sweet spot are those businesses, just like you all, that have ongoing revenue, ongoing employees that have a willingness and a capacity to grow. So that's where our impact is, and those are the value that we deliver to business owners.
Thank you so much, Mark. You hit on so many great points. Would like to hear, the transaction is just the beginning. And hopefully you take that away from today. The transaction in acquiring a business, it's just the beginning. It's a tool. It's hopefully another tool you'll use as you go through the process, growing through acquisition, as Talbot had mentioned. But running the business successfully is where the value is created. The value can be destroyed by paying too much and some other things in the transaction, but the real value creation comes through running the business. So we're trying to help you figure out how you get in, and then how we team you with the right resources to continue to grow. So can each of you talk a bit about, as folks are thinking about buying a business, what do they need to do to get ready? What would be your recommendation for our future entrepreneurs or entrepreneurs who are going to grow through acquisition? What's the recommendation? How do they get ready?
Okay, so if you call me, we are an SBA preferred lender. And so basically, for deals that have a little hair around them, we try to get an SBA guarantee on it to ensure that if it defaults, that we can get a portion of our money back. And so we'll look for SBA guarantee on that deal. But I have to do a credit memo, so I always tell people, I'm the advocate between you and the underwriter. And so the more I understand about your business model, how money comes in and out of your account, your cash flow, the better I can be an advocate. So the first thing that we're gonna wanna know is, what is it about you that's gonna make this business you're purchasing be successful? Because it's successful because of his leadership. But how do we know that you're gonna be able to lead it the same way to be able to service the debt? And so we're gonna ask for a resume. And so we have to be able to see some commonality in your background and your history that gives indication that you know what you're doing if you buy this building. So point in case, if you sold tires your entire life, and all you've done was sold tires, but now you wanna buy a restaurant, okay, those principles are not transferable. So I'm gonna need to know and be able to show, because I have to mitigate the risk that your knowledge poses in buying this new business to make the bank feel comfortable in understanding that you're gonna be successful. Then I'm gonna ask you about your credit. Because in this lending, this lending environment, everybody gotta do a personal guarantee. And so when I say that, I have a lot of people that wanna get off the phone immediately. And I say, no, listen, here's how I want you to look at it. So you're basically telling me, you want me to take a risk in lending money to your business that you're not willing to risk your name on. Because the only way the personal guarantee becomes an issue is if the business fails. Because if we approve it, the loan does not show up on your personal credit, does not affect your personal debt to income, does not affect you personally in no way. The only risk it has is if your business fails, we are going to look for you to help service that debt. So if you're worried that your business is going to fail and you don't want to put your name on it, then why should I lend it to you?
That's right.
And so once we get all of those things, and then I'm gonna need the returns from the previous business. And when I get those current returns, and I'm gonna look at what their net revenue is, and the next thing I'm gonna do is go to that Schedule L to look at what your what debt that business has. And at that point, you're gonna need to let me know that it's an asset deal and those debts going with them, and I'm gonna need to be able to prove that on paper to my underwriter to make sure that you can service that debt. So your credit needs to be satisfactory. We're gonna put a lien, a UCC lien, so that's gonna show up. I'm gonna look at the history of that business, how it's ran, the cash flow, the ownership model, and then the other part of that's gonna be me looking at you to make sure that you are in a position to be able to run that business successfully. And then I'm gonna reach out to my underwriter and send everything to them to try to see if we can get an SBA guarantee on it.
So what I would say is, from an SBA perspective, is one, the lender is the last place that you go. That's the last stop. Because the lender is not trying to make the deal work for you. The lender is really there to finance it, and that's a business. That's their business. They're making sure that they can fund a business. Each lender is going to be different. So one of the first things we tell our customers is that, know the numbers that you're working with, your personal numbers, and then also the business numbers, whether it's a startup business or a business that you're acquiring. We also want to make sure that you meet with one of our partners, like Mark at the SBDC, or one of our other partners at SCORE or the Women's Business Center, to make sure that you have thought through the process of what you need, is your package together. So knowing all your numbers means, okay, from a business standpoint, am I prepared to launch into this business, whether I'm acquiring an existing business or I am an existing business looking for additional capital, or start a business. It's important that you also look at your personal side of things, because most people say, well, I don't, my personal doesn't have anything to do with it, but you are your business in a small business. So until you get to that larger scale business, you are really the business, and so all lenders are gonna look at that. So we wanna make sure that as you're launching into this, you're gonna have a lot of no's, you can get to the yes, but making sure that you have everything available. So what SBA Resource Partners do is help you get that package together, help you think through the process, make sure everything is in order, so that you're ready to launch into whatever type of transaction it is, and then they walk you through the process. And so that's why it's really important at the beginning to get that assistance. If you're good at doing one thing, you're not good at doing something else. You can't be all things to everyone. So making sure the numbers are right, so that whomever the lender is, SBA is the minimum requirement, but each lender has multiple requirements. Most people call and just say, I need to get a loan. They don't know how much they need. They don't know how they're gonna deploy it. More importantly, they don't even know how they're gonna pay it back. And so that's the hardest part. Really, the easiest part is getting the loan. And I know people don't think that, but the easiest part is getting the loan. The hardest part is paying it back, because even if you acquire a business, it has revenue streams. But what you have to consider when you buy a business, you're gonna have some fall off. There is some fluff in that as well. There's what we talk about, discretionary seller income. There's someone in that business that may be family members that work in that business. So there are some things that once you get into it in that existing business that you may not be privy to, that will hit you once you get into the business. And making sure that you position yourself that when those things happen, you have enough capital to cure that, but also that you have the assistance from our resource partners to kind of help you navigate through that process. And in any business, if they're working a small business, especially if they're used to working with the owner all the time and that owner goes away, because for SBA, if you're getting an SBA loan, the owner has to leave the business unless you're doing another type of transaction. We do have multiple types of transactions where the owner can stay in the business. But if you're buying a business completely out, that owner has to exit the business within 12 months. Some people want that business owner to leave sooner, but we can talk about that later. But from Mark's perspective, what you say for your answer?
Well, why going to them is important, because I've had deals that died at takeoff because your stated purpose was outside of our policy. So we won't do a loan for payroll. So if you come in saying, hey, most of this is gonna be for payroll, then I'll have to automatically decline you off the rip, because your express purpose is not, it goes against our policy. Or right now, we're not lending to income producing properties. So if your building is not 100% occupied, if you say, yeah, we have about 80%, but about 10, 15%, we rent or lease out, that deal is dead from jump, because we're no longer lending to income producing properties. So going to someone like them first, helping you put that packet together before you come to me, because once you tell me, I have to ethically go by it, which is why I always tell you, don't send me your tax returns if I don't ask for them. I've had a deal approved with no returns, but because the customer sent the returns, the underwriter had to view them, the deal getting cash flow, and it was declined.
No,
So other thing is only send what we ask you for.
No, that's a great point. When you're purchasing a business, you have the historical financials. But we help you build those projections out, because every bank is gonna wanna see the projections, he's gonna wanna see the market data, he's gonna wanna see the psychographics and demographics of the area of its physical location. And we help you package all that together. We consult around what we call the 5 core business functional areas, and those are strategic planning, marketing, operational excellence, human resources management, and financial reporting. So putting that business plan together in the most cohesive and coherent manner will give you the best opportunity to get that loan approved when you send it to Mr. Banker over here.
And arguably, you as the acquirer is a stakeholder with the biggest interest in it being successful, because Terrence is still gonna be able to go home, sleep in his house, and be okay at night if the numbers don't work. Talbert mentioned he's looking for businesses where there's upside. I tell buyers all the time, if you don't see upside, if there's not a growth story, if you're in an industry that you think is gonna die, so if we're looking at typewriters in 1985, probably not the best place to get in. So the work that Mark and his team's doing is to help you to identify where is the world going. And are you confident before you make the personal guarantee that you are looking at the right type of asset in the right market? And so again, the resources are there to help you think through that. The leadership falls back on you, and a part of that leadership is how do you build a team with individuals here. So we've thrown out some terms. We want to go a little bit deeper. So we've talked about 7A loans, and Rosemary, maybe it's helpful for you to help us think about what are our loan options.
Okay, so there are multiple loan options. SBA is just one vehicle. And so what SBA does is we help mitigate the risk to the lender. So our agreement is with the lender and not the borrower. Most people think it is an agreement between us and you. It only becomes an agreement with us and you when you default, because they go to the Treasury, and Treasury collects. So most lenders that are approved SBA lenders, they're deploying the funds, they're doing everything on the loan, they're actually underwriting the loan based on SBA's standard operating procedures. So our operating procedures is our policy. And so it's based on a code of federal regulation. That's the minimum guideline. So what SBA dictates to our lenders is that if you do an SBA loan, whether it's a 7A loan, and 7A is nothing more than Section 7A of the Small Business Act, and you can borrow up to $5 million on a 7A loan, and you can use it for multiple uses, including acquiring a small business. You can also do it for partner buyouts. So with the Section 7A loan, the lender is deploying the funds. They're actually going to service the loan. They're going to approve it, close it, service it, and also liquidate it. And what happens in the event of default, you can actually get up to a 90% guarantee on an SBA loan. The 90% comes into play if it's an international trade loan. And typically our loans are anywhere from 75 to 85% guarantee. That guarantee is to the lender, not to the borrower. It says to the lender, if this borrower defaults, we will make you whole, being SBA will make you whole up to 75 or 85% or 90% of your guarantee of the outstanding balance after the loan has been liquidated. So you're not dealing directly with SBA. We leverage banks and financial institutions, CDFIs, non-bank lenders to deploy their funds, and then they're gonna come back to SBA in the event of default. And so typically what you're gonna have, and we have our 504 loan program.
Which is what we mostly do.
504 is fixed assets, and you can use a combination of our 7A loan and our 504 loan. Don't worry about the structure, because any good lender will structure the deal for you. So let's say if you're acquiring a business and you have real estate with that business, you can conceptually do a 504 loan, which is job creation and a fixed asset, and you can finance a loan up to 25 years when it has real estate in it. So we will put the real estate in a 504 loan, and then your business acquisition based on the goodwill of the business and some working capital and perhaps equipment can all go into a 7A loan. But if you have a business acquisition loan without any real estate, let's say it's all goodwill, intangibles, the max you can term that out is 10 years. There is also a misconception that SBA is low interest rate. SBA is not actually a low interest rate loan, with the exception of our disaster relief loans, because they're for disaster, and that's our only direct loan program. Then we have our 504 loan, which is a portion of that is fixed. So it's a two-party loan. You have a conventional first mortgage, and then you have an SBA 7A loan, SBA loan that's on a debenture that's fixed for the life of the loan. The 7A loan can be variable or fixed. The lender dictates the rate based on the strength of the business. Typically, if it's under collateralized, which means you don't have a lot of security, you have goodwill, you're gonna get the higher interest rate. So the higher interest rate is gonna be based on prime, typically the Wall Street prime, and then it can go up to, for under $50,000, it can go up to 6% over prime. If it's over 350,000, it cannot go over 3% over prime. So the lender actually dictates the rate based on the strength of you and the underwriting of that particular transaction. Working with our partners can help you determine which loans you qualify for. There's also the Small Business State Credit Initiative, Small Business
State Credit Initiative,
SSBCI. I was gonna say the acronym, but, and that's also another vehicle, but there are a lot of different programs that can help small businesses. So we tend to tell people, don't go in and say, I just want a 7A loan, because there are different types of 7A loans. There's something called SBA Express. We have revolving lines of credit. Typically, what you're gonna be asking for is, do they offer SBA financing? If they offer SBA financing, what you wanna ask is, can you have the SBA loan officer at the table when you have a discussion? Because typically, what you'll have, if you have a stronger transaction, you may be better off with a conventional loan. A conventional loan, if you're looking for a low interest rate, it's gonna give you that. The benefit of an SBA loan is it's gonna give you a longer term. You can term it out over 10 years. That gives you the flexibility if something happens in the business, your cash flow has the ability to absorb ebbs and flows in the business over a longer period of time. SBA loans do carry no prepayment penalty if it's under 15 years. So you can prepay the loan at any given time without any penalty. If it goes over 15 years, there is a prepayment penalty, but only for the first 3 years, and it's a declining scale. But if you have an opportunity, I wouldn't look at all the nuances of an SBA loan, because most times when people go into a bank, they ask for an SBA loan. Each bank, as Terrence just said, has a different policy for SBA, because our SOP is the minimum standard.
Because what we're gonna try to do is see if we can underwrite it based on our own guidelines.
Right.
Because it's a quicker process. Depending upon what our guidelines are, I can take your app today and you can be in the bank by Friday with the ACH going into your account if it's our own underwriting. What SBA does is allow for banks to be able to give financing to business that would not typically be able to get it because of risk.
Got it. Right.
And there are some strong deals, so I will say this, because this is important. SBA does not make a bad loan good. SBA makes a good loan better.
There you go.
Okay.
So if you're going into the transaction and you're buying the business and the business does not cash flow, you can help with financial projections. However, if it's declining trends, if there's other things going on with it, doesn't mean, oh, it's an SBA loan, we're gonna automatically guarantee the loan. It makes a good loan better. It mitigates if there's insufficient collateral, insufficient equity into it. I heard 20%. SBA's minimum into a transaction is 10%. If it's a new business, it adds on another 5%. If it's a specialty business, it adds on another 5%. So if you're acquiring a business, you can go in as little as 10% down for SBA's purposes. A bank may require you to come in with more.
So what we'll end up doing, we had that conversation, and I asked you what it is you're looking to do. Maybe we need to put some capital in place first and work on cash flow, adding your deposits, and then maybe come back in another year with looking at SBA, because we've been able to get you that financing. Maybe it was a line of credit, maybe it was some other type of lending that put you in a position where you can have that 10 to 15% down. Because you can't come in, do a loan for the 20%, then turn around and do a SBA loan and then finance both portions of it. And so, but there are ways we can kind of get you in a position for where, you know, we can't do it now, but we probably can in another year, have you in position to where now you can go in and get the financing. And then we'll only go in first position. And so as you try to figure out what bank you're gonna do what with, we will only take first position on a loan. If it's collateral, we will only take first position. If somebody else is already on there and they're willing to subordinate and let us jump ahead, then we got some opportunity, but we will never subordinate. Now we'll subordinate on our own loans. If we already have a loan on it and you have some equity and you wanna do something, then yeah, we can do it because we'll subordinate our own position, but we will only take first position on that loan.
Also, there's some specialized loan programs out here as well, in addition to the SSBCI. There's a loan fund under CDFI right now that if you have revenue
Hey, Mark, can you clarify what CDFI is?
I'm sorry, Community Development Financial Institution. Those are a group of federally chartered banks that have a specific charter to get more money into the hands of the underserved businesses. And in parentheses, that means women and minority-owned businesses, more or less. But they have special loan funds, and you guys can reach out to them. If you have revenue north of $300,000, you can get 5% money out of this loan fund, which is unheard of nowadays. Now, they're not gonna loan you $1 million on that, but you can get 100,000, 200,000, 300,000 based on your revenue. But I'll be happy to distribute that information to folks, but they have to call them on an individual basis because there's kind of a qualifying you have to take them through before I can pass them on. So.
Thank you, Mark. We heard on the earlier panel, real estate, business, and collateral. We've talked about it a bit as well. I think one of the beauties of the SBA program is many service-based businesses don't have any collateral. And so a bank has a hard time going in and saying, I'm underwriting that risk. If you default, what do I have? If you don't have anything, I can't come after it. How am I gonna get home? So the government guarantee through the SBA provides an avenue to get access to capital to business owners. So that's one route. The real estate piece is also really, really interesting because now you have an asset. So looking at a business and what that can do in terms of wealth creation, along with the commercial real estate and owning your own commercial real estate, you own the entire package. And I heard up to 25 years. So when you start looking at the amortization schedule, and if anyone has any questions on terminology, let me know. It's ready to raise your hand. We'll go deeper into that.
Thank you.
That provides you an opportunity to allow the cash flow from the business to pay for not only the business, but also the real estate. You can go back and sell the business at the end of the life cycle and still have the real estate, and you can have a tenant and you have an annuity stream. It gives a lot of flexibility and it gives you options. And so we're here today. How do you, as you're stepping back and meeting with Mark, how do you develop your strategy? Because it all starts with strategy. So I would encourage everyone, we talked about investment thesis. I think broadly, what is your overall investment strategy and how does the thesis play into that? And I would argue that the first stop is with Mark. Mark, can you share a bit about how you help potential acquirers develop that strategy?
Sure. We'll take our intake process is very simple. You contact us. We have 18 offices around the state. There's an area director at each one of those 18 offices. I'm the area director of the DeKalb office. But you reach out to us. The intake form is ready. You just fill out a client form. That's all you have to do, and then you have access to all of our services from that point forward. Once you have identified through Carl a business that you want to purchase, obviously the seller will provide you with all the financial history of the business, but your banker is going to want to see your projections from there going forward. If the value proposition isn't going to change much, the foundational success of the business is still going to continue, then those are fairly easy to do. If the projections or the core businesses are going to change, then those projections become a bit more tricky, because a lot more other details that have to go into it. But we'll help you build out your projections. One thing we do not do is we do not write the narrative portion of a business plan. That has to come from the actual borrower and purchaser. That's not the business that we're in, but we will help you put the projections together. Now, if someone comes to me and says, hey, I don't know how to write a business plan, I have two options for you. I have a business plan template that I can share with you. And I also have access, we have a deeply discounted rate to liveplan.com, I don't know if you guys ever heard of them. Great tool to spit out professionally looking business plans. And we have a discounted rate. We get 6 months worth of access for only $65. So typically I present both options to my clients. Here's a template, here's the live plan. He says $65, I don't want to do the template. Just, I'll go ahead and get it done the other way. But we take you through the projections, turn it back over to the.
Cause I'm gonna ask you for that.
Oh,
I'm
yeah.
gonna ask you for your business plan, your pro forma, and I wanna see your 3-year cash flow projections, and the first year has to be broken out monthly.
Yep, that's right. So we also provide not only the P&Ls projections, but also the cash flow projection that they're gonna need on we can do 24, 36 months.
Cause we gotta see if the business can service the debt, and why your personal becomes important. Because if you're now finna transition to being fully employed by the business, then not only I gotta run a calculation to see if you can service that loan, now I gotta make sure you're gonna have enough money to pay yourself for your own household bills. And so coming to me, so let me tell you something about underwriters. The minute they see a string, they're gonna pull it. And so the best thing for you to do is have everything that is needed up front where they can just underwrite the deal and the deal is clean. The minute they see something that calls pause, it's just gonna lead to way more questions, which is why getting with somebody that does this every day before you get to me can help make or break your opportunity at getting funding.
Absolutely.
And I will add to that, because I used to be an underwriter, and I had, back in the 90s, I had $1 million authority. And so a lot of times people don't look at their own personal credit reports to see how much debt they have out there, and having to do what we call a global cash flow to make sure that you as a business owner have sufficient income coming in to meet your personal debt service. So whatever you have on your credit report and any of the debt that we pull that you may not put on that personal financial statement, you might have one thing on your personal financial statement and it may be some additional things on your credit report. As an underwriter, I'm pulling everything off of your credit report. If you have a lot of lines of credits, even though you don't draw on it, I'm gonna take a percentage of that and I'm gonna assume that you're gonna draw on that. And I'm gonna show that you have to service that debt. And so I'm going to make what you have to live off of and all the things that you have to pay, that's gonna be your required salary. So if you're buying a business and typically we add back in the seller's salary, let's say they took $75,000 out of business, we add that back in. But when we do go back in, and this is my underwriter hat, we look at exactly how much you need to pull from that business, especially if you don't have a secondary source of income coming in to meet that service. So that's really important when you're looking at buying a business, especially when you're maybe coming out of corporate America where you have a salary. That's kind of how my first entrepreneurial venture went. I was laid off, and so I came into the business. But they took out the salary that I made, and they made sure that from a business standpoint. And my spouse wouldn't sign personal guarantees, so I wanted pulling out some money out of a home equity loan and start my business with $50,000 from Bank of America.
There's just one really important point you said there. They will ask you how much money you need to pay yourself. They'll ask you as a free open in there. It's not a trap question, but you gotta be careful of how you answer it. How much do you need? And you could go look at your expenses and maybe you need $100,000 to live. They will factor that in. If you say, I want $500,000, they will write down, I want and the loan will fail because it won't produce enough for that.
But to your point, I've had people state a salary, and when we looked at their credit report, it was like, that won't even cover their, like that debt to income ratio is out of like, how are you even making it off that? Like, so you gotta make sure you look at your own debt and make sure that the salary that you're saying you need will have your personal debt to income at a ratio where it looks like you can pay that without having to struggle.
Oh, yeah.
Here's the bigger insight to what you just said there. If you're going down this path, you really need to understand your personal financial situation.
Correct.
Net worth. What is your net worth? Which forces you to identify all of your debt and all of your assets. How much income you're taking in, how much. If you walk into to any of their offices and you don't even know that, you don't want that to be discovered after you've applied for the loan. Fastest way to failure.
And in a franchise, if we have Goddard here, that's one of the requirements in order to get a franchise. You have to provide that. They look at your personal financial, they look at net worth. You have to have a certain level of net worth depending on the type of franchise that you're going to purchase. because they wanna make sure you're successful too, coming into their network.
And I've had a lot of clients who come in and they say, you know, I give them the projections or done and say, fine, I'm gonna go quit my job. No, don't do that, because the underwriters are gonna look at your overall income stream that you've got coming in. So I always encourage people, if you've got a job and you don't have to leave it right now, keep that job income, because that will help you in the qualifying process.
Yeah, all we're gonna do is punch in numbers. We're gonna take those returns, we're gonna punch in all those numbers, we're gonna punch in what you're paying, we can add depreciation back, and at the end of that spreadsheet, it's gonna give me a percentage. And it's just gonna be whether or not that's within our range.
Well, and I think for this room, most people probably aren't sitting on the cusp of a deal tomorrow. So the beauty is you have the opportunity to prepare. You have the opportunity to make sure that you know what your credit score is, you know what your net worth is, well in advance. And actually, it probably frames the deals that you can look at. So if you know that your net worth is X, we know it's 10 to 20% down, back of the envelope math, what size business am I gonna do? We talked earlier, 2 to 3X in terms of multiple. You can go home and figure out, this is the size of business that I'm gonna do. So that's the point, is before you step into anyone's office, go do the back of the envelope math for what you can do. Because you don't need to be looking at a $5 million business if you only have $15,000 in the bank. It's not gonna matter.
Or if you wanna do that, you need to get some partners. You need to find equity partners. A lot of small businesses don't look beyond themselves. They say, I wanna buy this business. Come together with a group of friends or someone that you looked at their financial information and say, okay, we wanna invest in a business, and this is what each equity partner needs to bring to the table, and you determine, you can bring money to the table, you don't necessarily have to have the same equity structure based on that's negotiation. But I would say if you do go in this with partners, that you have your exit strategy before you start, because every relationship starts well. They never end.
Buy-sell agreement. Google buy-sell agreement, and make sure that if you work with partners and even your spouse, you have a buy-sell agreement.
And an operating agreement
Yes.
as well.
And then for us, if one of you got really great credit, it's not like going to get a car loan, you just add a cosigner. If someone has challenged credit, that can kill the whole deal. It can be 3 of y'all, 2 of you can be 800, 1 can be 520, and I'm gonna have a hard time getting it across the field. And so it's not a situation like that. And then for us, everybody that owns at least 20% of the business has to go on as a personal guarantor.
And that's an SBA requirement. However, if you own less than 20% of the business and you're a key owner of the business, you still have to guarantee. If you have a spouse and they only own 5% of the business, the spouse still has to guarantee. So also look at if you have a spouse that owns a business or they're thinking about owning a business, be careful about how you put them on your corporate documents, because from an SBA standpoint, if a spouse is any type of officer in the business, they have less than 20%, they're required to guarantee. We're mandated that they have to guarantee the loan. So it's important when you work with our resource partners that you understand what you want to do past this first transaction.
Good.
So don't leverage everything for the very first transaction, because there may be multiple transactions coming down. Think through the bigger strategy. If you're trying to grow through acquisition, understand, don't put everything in the pot the first time, because when you try and go to the next transaction, you may not be eligible because you tied up everything into this transaction.
So to what you just said, if it's 3 partners, they all personal guarantee the loan. 5 years later, one wants to get out, but they're already tied to that loan. What happens?
Well, you can actually buy that partner out. You can actually use SBA funds to buy that partner out. You can do a partner buyout. You can actually, we have what we call the employee stock ownership. You can actually sell your business to your employees. We have some business owners that actually use that when they grow and scale their businesses. They actually sell it to their employees and they retain the business. You can actually do that with an SBA loan. So there's different types of acquisition that you can do through SBA transactions. It could be a full, you're coming from outside of the business, you're buying the business. You are in the business, you're gonna buy your partners out. You are going to have sell your business to your employees through an ESOP.
So Carl mentioned earlier that this is chess, not checkers. And if you're talking to an entrepreneur that's planning on scaling through acquisitions, multiple acquisitions, can you talk about what that looks like, what that ideal, package looks like, and what they need to be prepared for in order to not just make that first acquisition, but subsequent acquisitions?
So you don't take it directly to the bank. So I will tell you, as a lender, a former lender, and as an underwriter, when you come to a lender and you say, okay, this is what I'm trying to do at the very end, they're looking at the first transaction. So you want to meet with your advisory panel, whether it be our resource partners, and say, okay, here's my strategy. I've put together a strategy. I want to buy this type of business and I want to grow and scale it here. Here's what I want to do for the first one, and how long after that you want to do the second one. If you're doing a franchise concept, you have to buy a territory. So you're going to be required to do so many in so many months or a year. If you're looking at, for a non-franchise type, if you're looking at taking that money, it's a different type of loan. SBA doesn't allow you to do that, but there are traditional loans where you may be able to say, okay, let's say UPS stores, for example. I want to buy a UPS route. And so I want to buy 15 of them, and I want to start here. You can borrow up to $5 million on an SBA loan, but what you have to do is make sure it can cash flow at the onset and how much you can put in. Our resource partner can kind of help you lay that out so that you can say, okay, here's my strategy. I'm going to buy this one. I'm going to guarantee if you're going to bring another partner in, then structure that. You can actually do structuring up front for that, but it could be, maybe you're going to do it under one corporate umbrella. You might do multiple corporate umbrellas, but that's an opportunity to sit down with someone that has, to see your vision with you, of course, but then to also help you structure the transactions, because the corporate veil has to be set up first, and how you're going to carry that out. Because if you set the corporate veil up wrong in the beginning, it's going to be hard for you to do another transaction without incorporating that corporate veil.
Rosemary, I'm glad you brought up franchising. One of the things we have at our disposal is we have some specialized folks within our organization. One guy in my office, 24 years experience in franchising, is a CPA, MBA. So if you're looking at a franchise, you want to sit down with him and kind of ask these kind of questions so he can kind of give you a blueprint for how you're going to succeed in the franchise business. Same thing if you're looking at going international. If you have a product or service you want to sell internationally, and the majority of the world's consumers live outside this country. We have a dedicated international trade office where we can sit down with you and plot a strategy for how you want to enter the international trade market.
And so, to that, okay.
Quick tangent on it. I just want to, and we're gonna open up for questions here in just
Did I
one
answer your
moment.
question?
You did, however, I just want to say that I have been declined for many loans, even though I've had great credit, because I've
Yes.
built through several reasons. I've built a lot of real estate, and so that would show up, as Terrence pointed out, on my credit report, even though I may not have accurately captured it in my revenue as I was, kind of, so I had to build a personal financial statement personally that I just have in Excel, and I look at it every month and update it every month. So I actually look at, what they need and have a file on my laptop from last 3 years tax returns, and I just keep updating it and just have that file together so that going out and getting money is not easy. And Terrence may not like this, my banker friend may not like this, but I always talk to more than one bank too, because I don't want to get to the altar and be like, well, you didn't quite cross this T the right way, and then just be stuck.
Well, it's important too, because the different banks have different appetites. So you may be doing a transaction where their credit culture may not facilitate that particular transaction, and they may have a relationship with you. And the reality is, if they don't do a certain type of franchise or a certain type of deal, it doesn't matter how good your credit is, how strong the deal is. Banks don't make exceptions, because when they make exceptions, that means from a regulatory standpoint, they're
We can be
reserved.
sued.
They're reserved. They have to put up additional reserves. So banks are highly regulated, and so what you'll find is those that the lenders that go outside of the box are going to be your non-bank lenders, your fintechs, and other type of lenders. They'll go outside of the box, but guess what? You're going to have different terms. It's right, the cost of it, and then they'll be able to foreclose on it pretty quickly.
Yeah, some of those places you rent money.
Right, it's 30, Georgia's a 30-day foreclosure state, so, and if you miss a payment, even from an SBA standpoint, if you default on a payment, now, that's the only way they can call an SBA loan, so if you make a payment default, the lender can start the liquidation process. On a non-SBA loan, it doesn't have to be a payment default, it's a covenant default. So SBA, we don't have covenants within most of our SBA loans, and covenants are, you have to meet certain thresholds in order to make your loan current, because if not, you go to asset, you go to a recovery. And so what they're doing is they're saying, okay, this loan has a risk of failing because it missed one of its covenants. So there could be a covenant in there where your net worth has to stay a certain way. It could be a covenant where you can't take a certain amount of money out of your company. So be careful when you have covenants, because if there's covenants built into when they approve a loan, the lender has to abide by those covenants. And even if you're paying, with the exception of an SBA loan, because SBA loans can only be a payment default, you could be paying your loan, and next thing you know, you're gonna have someone calling you from a collection part of the bank because you missed a covenant.
But to his point, I'll be real quick. To his point, so if you do have a business entity that has strong cash flow, so I got a client that owns multiple franchises, and we were able to take his oldest existing franchise that has solid cash flow, and we was able to get him financing under his new franchise that he had under a new LLC by using his existing business and him as personal guarantees, which allowed us to be able to cash flow the deal based on his existing business revenues. So we was able to put that debt under the new business because we was able to use his existing business as a personal guarantee for that other business. That's why you clearly knowing what it is that you're trying to do helps greatly when we sit down and have the conversation about, okay, hey, what are you looking for? So the more I know, because he would have never mentioned that he had that other business, that would have never even been an option. So it's not that we're trying to be nosy when we're asking questions. We're trying to figure out a way to do the deal. If I don't lend, my kids don't eat. So we want to lend, and banks thrive off lending because we can balance sheet that entire loan when it closes. So we want to lend. We're looking for ways to try to approve it, but sometimes you have the information, but I don't know, sometimes it's like you're scared to share it, like we're gonna use it against you. But like the more we know and the more we understand, we might can figure out a way to get the structure right where we can get it across the finish line.
I'd like to yield the floor to Ms. Watts.
I just have a question. How does the SBIC, the investment centers, play into any of the acquisitions for small business? I'm not sure.
Small Business Investment Corporations,
The SBIC, the centers that's.
SBDCs, because we do have an SBIC.
The SBIC.
The SBIC, so yes, so the investment vehicle, so it depends on the type of transaction it is. So some of them may help you, so that's where it's private and public dollars coming together, where you have investors that invest into companies. And some of them, it depends on if they're investing in that type of industry. They don't always necessarily invest in business acquisitions. Sometimes it's technology, sometimes it's medical, so different small business investment corporations, they're looking at coming into your business and either from an equity standpoint, investing equity into a particular business, and they're helping you to kind of manage, scale, and grow that business from the SBIC standpoint. So merger and acquisition happened there, but mostly that's looking at putting equity into an existing company. Did I answer your question, Paula?
Yes, yes.
Yeah, so, I am a testimony of the whole process here. My wife, she just opened up an OBGYN office. And that whole process of actually going through, that's because she's been working in there for like last 7-8 years as an actual OBGYN for another company or office or whatever. And she wanted to go through that process. She had to go through there, Mr. B set up all the financials, everything. And she had to go to a bank, but didn't nobody want to lend to her because she's brand new, right? Even though she had the credit, you saw she had the business, all that kind of stuff. But the only time she was able to get the funding was from her old bank that she's been having for 25 years. They was able to lend to her through the SBA, but then they did something like.
You didn't call me?
Well, the reason why I'm asking this is I want to make, for you, I want to make sure it's normal. Well, they took over all the money. So they say, I'm gonna lend you $100,000 in lending, and then I'm gonna give you another $100,000 in line of credit. But you can't use this for this, you can't use that for that. And I'm like, is that like a normal practice where they like nitpicking? You gotta take pictures of everything, like nitpicking every.
Well, no, we want to know how those funds are going to be dispersed, because lines of credit are for cash flow issues.
Right.
You know, and if you got an immediate need, you need a loan. So if you're
Right.
doing construction and things of that
Exactly.
nature,
They didn't
then
want
yeah,
to put the
you
money.
want to do a loan. One, the interest rate is going to be better. It's a fixed
Correct.
payment over time. But I'm gonna let.
So I will tell you from a standpoint, it depends, it sounds like, if she got an SBA loan, sounds like it might have been, a portion of it's revolving. Each bank does it differently. They have to, if it's for working capital purposes, she can give them, okay, what she's gonna use it for.
Correct.
But typically, they'll disperse the funds. Some banks require more, but if it's for equipment that she's purchasing, especially in a facility like that, if she's buying equipment, they have to show the invoice to match it so that those funds were deployed for that particular asset. Working capital, usually they say, okay, give us your payroll, give us this, is something to substantiate. Because in the event of default for an SBA loan, if a lender has not deployed the funds properly and has not been used properly, then SBA will not honor the guarantee.
And then we got to file a UCC lien on every piece of equipment that is purchased.
So they'll
Right.
file a blanket UCC.
The issue we've been having is the whole time, they just now, like she's only 7 months, they just now gave her the construction money that's been, the thing been running last year, so they just now cut the money for that to actually send to the people for that. And I'm like, we had to use our own money the whole time.
That's out of the norm.
Yeah.
So,
I'm like, that's just not
in
normal.
that instance, we always tell you to call the SBA. We tell you to call the SBA directly, and we're the Georgia District Office, so if you call us, we typically reach out to the lender and see what the issues have been. It could have been that if there was a lien, then they wouldn't release the funds. There could be multiple reasons why they didn't release the funds. From a construction deal, they usually hold back contingency if there's been some change orders and things of that nature. If the landlord was providing some financing, usually the landlord financing comes in first, our money comes in last.
Correct.
So it depends on how the transaction was worked. And it could be that you just have a lender that's not experienced and they didn't know how to ask for the
It was
funds.
Regions Bank, I'm telling you.
Regis.
It's Regions Bank, that's what it was.
So Regis is an SBA lender, but just give us a call and we'll help you with your, because I actually know a lot of the folks. in there.
Just one quick question. You kept saying, get a loan and have to catapult that. Is there any way possible to buy a business that does not have cash flow to support the debt load?
There is. So let's say you're buying a business and it's basically break even. It should be at least break even. And then what you have to do is with the lender, one of our partners, justify. Because a lot of times small businesses, especially when they're solopreneurs, they tend to scale their business down because they've had health issues, they had something else, but then they want to sell the business. If you can really show that you're doing something additional, it could be you got a federal contract and you know that you're gonna be able to pull this in with a federal contract, so the revenue stream is gonna go up. So your projections, as long as it's at break even, and you can show a trend that, okay, the business, you'll have the last, let's say you have 2 to 3 years. If you go back that 4th year and you find the year that business was actually healthy, you can show why the business was declining. Now, you shouldn't be buying the business at a premium at this point. The business should be bought at a discount at this point. But then you can justify that with a new owner coming in, you're able to take it back to its original state, plus grow the revenues based on your experience and other things that you have going on, based on projections with assumptions, and then you can get it to a 1.25 debt service coverage ratio. It would be eligible for an SBA loan. So you have to write the narrative, the financial projections have to show that, and it has to make sense. But I would always go back, especially when the seller is trying to sell that business and they've had usually it's when they've had some health challenges or something that's happened and they're trying to sell the business. One, you don't buy it at a premium, you're buying it at a discount, but then you get to look at the financial projection and you can see the year that they did good and you can show, okay, they did this good this year and this is what happened. You've got to tell the story. The underwriter, if they can see the story and they can see the trends and you look at the expenses, because the expenses should follow, right?
Correct.
So then you look at that, then it would be eligible for a loan, depending upon what, you gotta go to the right lender that can understand that story. Not every lender's gonna understand the story.
Well, and I got you next, but there's one other tool that we haven't talked about, which is seller financing.
Yeah.
So particularly in the situations where businesses are underperforming, as a representative of sellers, in many instances, we have the conversation that if your business isn't cash flowing, you become the bank. And so that's something to consider as you're looking at deals, is that's another tool in your toolkit, is you have the seller carry the note, you negotiate the terms with the seller, and that's the penalty for waiting too long to potentially get out. So as you're in your businesses as well, as things start to come up and as you're planning, recognize that if the business doesn't qualify for financing through a conventional lender, then you oftentimes become the bank. So tool for your toolkit.
And a caveat for that also, the seller, you can do a short term. You can do a short-term note with the seller and look at refinancing with an SBA loan, because you can actually refinance seller debt with an SBA loan. So it'll give you a couple years of performing. It'll make it beneficial for the seller, so they don't have to stay long. They can at least 2 years. If you have at least 2 years, then you can turn around and buy that seller 2 years after you've been successful.
And I know as we're coming to an end, and there's a lot more questions, I just want to point out something on seller note. Understand that when there's a seller note, it's not the same terms as an SBA. The expectation isn't 10 years and, 10% down. A seller, by standard, will expect more cash. They might do 20, 30% seller note. They will never do 90% seller note, just so that everybody understands that if they're in that situation.
Ricardo, real quick.
So yeah, I wanted to ask about the international component. So I've got an acquisition piece as well going, but I've got some international investors. They have money, and they say, we want to buy assets in the US with you, which is me. I see the asset and I want a finance partner. What role do you play when I've got an international investor with money that's willing to back the deal up on the cash side, and I'm looking for some financing to corroborate that? What role would you play in that?
I would tell you, we don't have the appetite for that type of deal.
Okay. It's possible with SBA, however, that investor cannot have any significant ownership in the company, one. And then two, you have to remember that any monies that are coming into the transaction should be vested. So they have to be vested in a US account for 90 days. Most lenders were required to be vested in an account for 90 days. And then also, they can't have any control. So you have to have the control from an SBA standalone. You have to be a US citizen that owns the business. We have a lot of transactions that actually have foreign investors in them. They don't have any ownership. They have nominal ownership in the company and have no control, and they're not required to guarantee. So it is possible to do an SBA loan with foreign investors.
So just to clarify the control ownership piece, because obviously on paper you can own X number of shares, but you might give a larger contribution of capital, right? Can you just clarify?
So you can, from a revenue standpoint, if they get profitability, you can do that. But if they have any ownership, any ownership in the company, they have to guarantee. So not ownership, but key ownership. So if let's say they're investing and they have 1% ownership, but their profit, they get 50% of your profits. Some bank they may not want that, but from an SBA standpoint, it's eligible. So, but if let's say they're a VP or they have controlling interest, then you would have a challenge with SBA because they would have to guarantee. They cannot be able to guarantee that you have to be a US citizen.
And so that will look like a potential red flag to us, because it'll look like exactly what you're doing. Why does somebody that only owns this small percentage getting a lion's share of the revenue? And so it's gonna lead down another path, another road.
The key thing on that is there are situations that have complexity, and so you would have to talk with an attorney to set up your business structure in the right way for where the investors come in and how it is. That could be utilizing SBA and others. So it's a very specific type of thing to do, but I would consult with an attorney on how to set up your legal structure.
But it's possible. You can actually have foreign investors. I don't think most people know that. you can have foreign investors, because a lot of people have people that live, their family members that live outside of the country, and they give money to, or they invest in their companies. If it's a gift, SBA has to show it as a gift, and it has to be vested in the account. So you can also have family members that gift you money, and they can put money in the business as well. But that's very common, and it's common in certain cultures that people invest in businesses that are outside of the country. So that is very common.
But that's the thing, because the gentleman, I think it's you, who was on the panel earlier, and you talk about just being in yachts and charters and all that stuff with people who are doing things that we're not actually doing. And I know a lot of people who are doing those things, and they're doing it very well. And it's like, how do you actually do that? And that's exactly what they're doing. They've got a lot of money coming into the country, putting it into these assets. And it's like, dude, like, that's, how do you play that? And we're like totally doing
We could do a session on various ways international investors to come in. There's EB5, there's a whole category of stuff around that we could talk about, maybe getting some a session on that in particular.
One last question.
So just try to keep it as generic as possible. From a lending perspective and risk management, how do you evaluate businesses with cyclical income, right? So let's call it agricultural services, landscaping, pool service, the film industry is big in Georgia here. So you have a business that is generating cash flow but not on regular intervals. I guess, would you evaluate that any differently?
No, we're still gonna look at the end of the year, we're gonna look at it from an annual perspective. Like, actually, those are the type of clients that I try to fish for, because you're ideal for a line of credit, because you meet the very definition of cash flow need, that your business is seasonal or cyclical. And so those are the type of businesses that are right for a line of credit, because it's easy to attach the purpose to our policy.
And from an SBA perspective, we do have term loans that, and a lender can set up seasonal payments. We do farm lending, we do agricultural lending, we do a lot of lending to seasonal businesses. So seasonal businesses you may have a payment that you may only pay quarterly, or you may have payments that would be due in your peak season when you're making money, and it's just accruing interest during those other times, or you have an interest only, and then you have a lump sum payment. So SBA can be structured for seasonal business. And so you would write based on that seasonality, understanding when your season is. It could be multiple different types of seasons. Fall may be a good season, spring, and then that would be, you have 2 payments. If you have a crop or something like that, you would be basing your payments on those seasons. We have some businesses that have a one payment. They have a lump sum payment every year, and they make that they make a principal reduction every year, and then they may take interest only during the year. So there are multiple ways you can do that, but SBA does do seasonal.
And as we're working through the projections, we can help kind of smooth those averages out so that the underwriter will be able to take those types of things into consideration.
Well, I know there are a lot more questions. I hope that got to the heart of there's a lot here, right? This isn't the end of the conversation. Again, intended to spur thought, and the resources are here. So the nice thing is, you guys have already paid your taxpayer dollars for such resources. So we would encourage you to reach out after this, to continue to ask the questions and continue to learn more. As Carl mentioned, we'll make sure to share the information. We'd like to thank the panel so much for